Hi folks, this is David Schlossberg from Assured Concepts Group with our March 2016 Educational Economic Update. In this video, we'll talk about some of the economic headlines that influenced markets in the last month, and we'll give you some insight into what they can mean for you as an investor. After a very rocky January for stocks, February didn't offer investors any relief in volatility. That was still the name of the game. However, we did get some positive news. Let's talk about some of the month's major headlines. If you've been watching the news, you've probably heard a lot about a possible recession ahead. So the question of today, is a recession coming? Some economists are worried about a U.S. recession because of issues like low oil prices and commodity prices, emerging market problems in countries like China, and fears that central banks are out of tools to fight the economic troubles. These fears are not baseless. However, they don't necessarily mean a recession is coming. There are a lot of positives to consider. One indicator that argues against a coming U.S. recession is the labor market. The January jobs report showed that the economy gained 151,000 jobs that month. The gains pushed the headline unemployment rate down to 4.9%, the lowest it's been since February of '08. Another positive is that wages are finally growing and Americans are starting to spend some money, which is a good sign for the economy. In short, we don't know if a recession is coming, and neither does anyone else, regardless of what they say on TV. Recessions just don't happen for no reason at all, but we are taking those concerns seriously and watching the fundamentals carefully. Plummeting crude oil prices have a lot to do with the negative sentiment in recent months. Crude oil prices are so low because the world is awash in it, and the supply glut, combined with slowing demand from China, is pushing down the prices. Investors worry that persistently low oil prices will mean that the global economic growth situation is growing worse. Low prices also cut into energy company profits, as well as those companies with large stakes in the energy industry. With 87% of the S&P 500 companies reporting profits in, we see that the overall S&P 500 earnings were down 3.6% in the fourth quarter of 2015. However, if we remove the energy sector from the analysis, earnings actually grew a very healthy 2.5%. Firms that mostly depend on U.S. demand did even better. The overall economic picture wasn't as bad as expected last quarter. The second estimate of fourth quarter economic growth showed that the GDP grew at 1% rather than the 0.7% that was originally estimated. While economic growth decelerated in the last 3 months of the year, it didn't slow down as much as economists originally thought. Responding to concerns about economic growth, the Federal Reserve declined to raise interest rates again in its January meeting, keeping them low to boost investor confidence. While the Fed Open Market Committee will meet again in March, most economies don't think the Fed will hike rates again until June at the very earliest. The bottom line, 2016 has been a rocky road for investors, and the volatility is likely to last for a while. While corrections and uncertainty aren't easy, let's remember that they are coming after multiple years of solid equity growth, followed by 2015's flat results. Because of that volatility, adjustments have been made recently to most of our clients' accounts. We are keeping a close eye on fundamentals and helping our clients make informed decisions based on the latest research. If you have concerns about your personal financial situation in the current market, please give us a call at 847-426-1077. Please remember that nothing we talk about in this video is a recommendation, and if you'd like to discuss your personal financial situation, please give us that call. We'd be happy to talk to you. This is Dave Schlossberg, once again, signing off for the month of March.